It is Thursday, the 9th of January, and this is the Morning Blast with myself and Mr. Michael Brown, who's just joined us. Let me add him in. Invite to co-host. Morning, Mark. Morning, Luke. Invite sent. You should get this any second, Mr. Brown.
Good morning, Ryan. Good morning, everyone.
Good morning. 1 second, let me get the legals out of the way. Nothing discussed on this space session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited Traders, PIQ or PIQ Suite, or indeed the affiliates and the hosts, which, as you know by now, is Mr. Michael Brown, way, and myself, Mr. Ryan Paisley, way.
What?
Yeah. What's that? You sound very weird this morning.
Do I?
Yeah, sort of very tinny.
Oh, right. Oh, I'm not sure why that would be.
That's
sat in my usual place with my usual earphones here, so.
No, it's fine now. I don't know what that was. Maybe it's my speakers. I don't know. Right. What's been going on?
What's been going on? Well, the UK is completely fucked is what's going on, I think, is probably the best place to start this morning without putting too fine a point on it. Yes, exactly. Oh, dear. Well, good morning, everybody. It is a rather grim morning for market participants here in the UK. Yesterday was marked by a chunky sell-off in gilts across the curve, although focused on the long end, with 10-year gilt yields rising by 12 basis points to 4.8%, the highest level since August of 2008, and the 30-year gilt yield rising as much as 11 basis points to its fresh highs since 1998 at 5.35%. Not only that, but we did see the weakness in fixed income continue at the cash open this morning. 10 and 30-year gilt yields popping another 10 basis points higher as markets opened around about half an hour ago, although we have paired around about half of those losses as of when I left the desk about 5 minutes or so ago. The big concern, though, and I think the sign that the market is losing confidence in the UK Treasury and in the UK government is the fact that despite gilt yields moving, let's call it 20 basis points higher over the last 24 hours or so, the pound has actually traded about 1.5% softer over that period. And this morning, cable sinking below the 123 figure and trading to its lowest level since November of 2023. And I think that's the big worry and the big warning sign is when you've got yields moving higher and the respective currency in question moving lower. That's a pretty surefire sign that the market has lost confidence in a government's ability to control the fiscal backdrop. Now, I would say that, obviously we've seen weakness globally in fixed income over the back end of 2024 and into the early part of 2025. But it's clear that the UK has massively underperformed developed market peers. And the reason for that is that the UK has kind of a bit of a worst of all worlds scenario at the moment, where you've got this perilous fiscal backdrop. Rachel Reeves at the October budget left herself about 10 billion quid's worth of headroom. Yesterday, Capital Economics saying that headroom is probably down to £1 billion. And given the rise that we've seen, further rise that we've seen in gilt yields since they published that note, I would sort of finger in the air guess that there's probably no headroom left at all at this moment in time. You've also got the fact that the UK economy is not growing at all. We had GDP falling in both September and October, and the indicators that we've had since then, retail sales, PMIs, etc., have been subpar at best. And of course, on top of that, you've got the fact that inflation is still elevated here in the UK, CPI at 2.6%, although, of course, we get another inflation figure, the December reading, in the middle of next week. And of course, the fact that inflation is high means that the BOE cannot make a dovish pivot because inflation is nowhere near their 2% target, particularly when you look at core and when you look at services prices. So, in other words, the UK is in the middle of a stagflationary scenario, which will in turn keep the BOE relatively hawkish, and actually hawkish for all the wrong reasons at exactly the wrong time. And just to make things even worse, it would appear that unless I've been asleep at the wheel and completely missed something, the Treasury and Rachel Reeves have kind of gone missing in action.
Oh,
They've
massively.
made,
That's
no comment whatsoever. I'm pretty sure Rachel Reeves wasn't even in the Commons yesterday for Prime Minister's questions. The Telegraph did have some sources reports that they were running this morning, where the Treasury was saying, and I quote here, that it is pure speculation that the rising gilt yields has wiped out the UK's fiscal headroom, which is nonsense. It's not speculation when it's true. But I think the market is really at this stage going to be looking for some concrete comment and concrete commitment that the Treasury are going to get a handle on this, either by delivering further spending cuts, further revenue raising measures, and really to try and restore that degree of fiscal headroom and prevent a breach of the fiscal rules. But of course, the worry, and I was talking about this with our very good mutual friends at News Corp this morning, is of course we have a non-farm payrolls number due tomorrow. And it is not going to take much to embolden the bond bears globally to embark on another round of selling if we do get a very, very strong US labour market report
yeah.
tomorrow.
And this is the thing,
So,
right? If this happens, the blood is in the water for the gilts, right? So
absolutely.
what's the easiest thing to pick on? It's the gilts.
Absolutely. So the gilt market, and by extension UK PLC, is firmly in the market's crosshairs at the moment. And again, not trading advice, as we don't offer that on this show. But personally, I find it very difficult to be anything other than short sterling assets, whether it be rates, whether it be equity, whether it be currency. They're just until we actually hear something
Yeah,
from the Treasury, there is just no incentive to fade this market move, I don't think.
yeah. No, I'm with you there.
Oh dear, maybe I'll revise that call. Anyway,
Oh no.
anyway, moving away from the UK and on to other matters. We did have a few bits and bobs that are worth mentioning from yesterday. Again, the market buffeted by reports around Trump's trade policy. This time, CNN citing sources that Trump is apparently weighing whether to declare an economic emergency as he takes office, and that would provide the legal justification for the imposition of tariffs. Presently, there is a sort of statute in the United States that says you can only impose tariffs if for national security reasons, effectively. And if Trump were to declare an economic emergency, that would mean that he can basically just do what he likes. And a source that was quoted in that article said, and I quote here, nothing is off the table. So that did send risk lower as the headline crossed, although we did see equities recover as the day progressed. The S&P ending the day about 0.2% higher, the Nasdaq ending the day flat. But nonetheless, the dollar continuing to trade firmer against most G10 peers, and the dollar index managing to reclaim the 109 handle into the close yesterday. In terms of other things just worth covering, we had quite a lot in terms of the Fed yesterday. Of course, we have minutes out from the December meeting. They weren't particularly groundbreaking, to be completely honest with you, reiterating that a majority of policymakers saw the decision to deliver a 25 basis point cut at that meeting as finely balanced, and that almost all saw increased upside inflation risks compared to the prior meeting. And again, reiterating that participants expect to move towards a more neutral policy setting over time. Fed Governor Waller very much sticking to the script in his remarks yesterday as well, stating that he would support further cuts this year if the economic outlook evolves as expected, and that he expects inflation to move down over time. One thing that was interesting from Waller is that he said that tariffs are unlikely to impact his view on monetary policy. So for those who are saying that the Fed may adopt a more hawkish stance than the 50 bips of cuts implied by the dot plot, Waller pouring a little bit of cold water on that. And last but by no means least, in terms of the Fed, Bloomberg had a story out yesterday. Obviously, Fed Chair Powell is his term is up in the early part of 2026. Bloomberg was saying yesterday that a number of names are in the running as Trump's potential pick to replace Powell at the end of his term. Importantly, the piece did not make mention of Trump seeking to dismiss Powell before his term ends. But some of the names in the hat are reportedly including Kevin Hassett, who was one of Trump's economic advisors during his first term. David Malpass, who was Trump's pick to run the World Bank during his first term. Michelle Bowman, who is obviously already on the Fed board. And also Kevin Warsh, who is a name that always seems to be in the mix for these sort of things. He was on the Fed board back in the early part of the 2010s. I can't exactly remember when it was. And last but by no means least, we did have some US data out yesterday. ADP employment at 122,000 in December, marginally below the 139,000 consensus. But of course, the relationship with Friday's payrolls numbers is ropey at best. We did, though, have better than expected initial jobless claims at 201,000 in the week to the 4th of January. Again, though, this is covering the Christmas period, so do just bear in mind that the data is likely a little bit more volatile than normal. And of course, neither that nor the continuing claims print, which came in at 1.867 million, pertain to the December non-farm payroll survey week. And last but by no means least, the chunky week of US supply wrapped up yesterday with a solid 30-year auction, which stopped through the when issued yield by 0.7 basis points. And just for the record, that was $22 billion of 30-year bonds that were being sold there. And back to you, Ryan.
Perfect. Well, thank you very much for that, Mr. Brown. Before I just read out some selected headlines from Zach's awesome overnight news roundup that we put out every day on the Substack. Big shout out to Cam, who, as you know by now, hopefully you know by now, is doing our crypto stuff. He will be putting out a very short, concise, and very, very good crypto roundup in probably about half an hour, maybe 45 minutes, if I'm correct. Yeah, I'm sure he'll give us thumbs up or thumbs down if that's correct. It's coming out very soon, regardless. But anyway, some headlines via our friend Zach. So in macro world, yesterday was the busiest day for the pound options trading since the currency slumped towards an all-time low in 2022. Elon Musk reiterated that the Doge, whatever we're going to call it, will try to cut 2 trillion, that's with a T, from federal spending. But he said this was the best case outcome in a conversation with Mark Penn, chairman and CEO of ad company Stagwell. The union representing 45,000 dock workers in the US East and Gulf Coast and their employers on Wednesday said they reached a tentative deal on a new 6-year contract, which hopefully averts from further strikes. Elon Musk has privately discussed with allies how Keir Starmer could be removed as UK PM before the next election. That's according to FT sources. And Musk's view is that Western civilization itself is threatened, and that's a quote there. Which I think, yeah, I'm all for Trump. Sorry, start again. I'm all for Musk getting involved on, putting his weight behind certain matters that warrant his matters, but I'm not sure people are going to take too kindly to him trying to publicly oust politicians. I think that's a dangerous game to play, but I do understand what he's doing, and I am backing him on certain things. In terms of, I think we all know what I'm on about there. UK recruiters reported a further slowdown in hiring in December as companies sought to cut staffing costs. This in response to planned tax rises, new worker rights, and worsening economic climate. That's according to KPMG. And we've got a rally in liquefied natural gas. LNG has pushed Asian prices to a rare and substantial premium over oil, paving the way for major consumers to shift to cheaper but dirtier fuels. One significant thing in geopolitical news is Trump reposted an opinion piece that was posted in The Hill, and where it was said that there were 750,000 additional lives wasted in Ukraine for less than nothing. And the opinion piece went on to speak about the approaching ceasefire deal and how Ukraine will be in a much worse position for not considering a ceasefire sooner. And finally, just one thing to highlight in equities is nuclear energy companies led by Westinghouse are trying to shrink reactor sizes to the size of shipping containers in a bid to compete with electronic batteries as a source of zero carbon energy. And I really apologize for my voice today. I don't know what's happened. But anyway, back to you in the studio.
I was going to say you do sound particularly terrible this morning,
Yeah,
but
I'm not sure that
hopefully
is.
you're not. Hopefully you're not coming down with anything. Right, in terms of today, then, of course, the US is observing a National Day of Mourning in honor of former President Jimmy Carter. That does mean that cash, equity, and bond trading will be closed today. We also have a whole host of early finishes in terms of CME futures. Equity futures, they will have an early close at 2:30 London time. Rate futures, they will have an early close at 6:15 London time. At least I think they will. For whatever reason, I always struggle to work out where exactly on the CME website this information is. So do
Right.
just go and double
So
check that if you are trading yourself.
on this, obviously, CME, big friends of ours, big friends PIQ. However, if there was one thing, if anyone's listening, please sort out how you produce your own your holiday calendars.
Oh, I'm glad it's not just me.
Oh my god, that and their margin sheets. Oh my god, the hours. We're talking probably weeks of my life over the last 20 years. I've wasted weeks of my life trying to dissect. Just tell me when the market closes, please. That's all I want.
Yes, I think most market participants would agree with that. But the long and the short of it is, of course, with US participants largely away for the day, that does mean that volumes are likely to be relatively light, and subsequently liquidity will be like my hair, very, very thin indeed. Nevertheless, in terms of scheduled events, we have had a few things out overnight. We had retail sales out of Australia, which were a little bit softer than expected at 0.8% on a month-on-month basis, although this is November data, so it is a little bit stale. We've also had some inflation figures. Oh dear, what's happened there? Christ, dropped my bloody phone on the floor now.
What's happened? Is he falling off his chair?
No, well, almost. I've dropped my phone on the floor, so I was going to tell you about Chinese inflation, but then it disappeared. Right, I'm back. Chinese CPI, that rose by 0.1% in December. That was a further slowdown from the 0.2% that we saw in November, of course, as China remains on the precipice of falling back into deflation. In terms of the day ahead, the only scheduled release comes at 10 o'clock this morning, and that is the latest Eurozone retail sales figures. Sales expected to have risen by 0.3% on the month. Again, this is November data, although that would be a rebound from the 0.5% decline that we saw in October. Other things to keep an eye on, of course, there are no corporate earnings due today with the equity market being closed. We do have some speakers that are worth noting. We are due to hear from the BOE Deputy Governor Breeden, who is set to make remarks a little bit later on today. Not sure whether there will be a Q&A session with that speech, but if there is, there's only really going to be one topic that Sarah Breeden is asked about, and that will be developments in the gilt market. So it'll be interesting to see whether she has anything to say on that front. We are also scheduled, I should say, to hear from the Fed's Bowman, Schmid, Barkin, Collins, and Harker throughout the day today. All of those speeches are still on the calendar. I checked that a few moments ago before I joined this call. Although, of course, given the National Day of Mourning, I would say it's probably 50-50 as to whether those remarks actually take place or not. But do bear in mind that we could have a busy day of Fed speak ahead as well. And that is pretty much a lot from me today.
Perfect. Thank you very much, Mr. Michael Brown. Listeners, thank you as always for tuning in. Well, as Michael said, it's the potentially a holiday today in the US, so expect thin and wispy liquidity, like his Barnet. So if you are trading, keep it tight, and we will see you tomorrow. Take care.
Indeed. Jobs day tomorrow.
Oh, lovely. Pub.
Bye-bye.
See ya.